Let's take a look now at two vulnerabilities we're watching closely: household debt and housing, and their relationship to financial stability. Housing is certainly top of mind for many Canadians these days.
Carolyn Rogers from the Bank of Canada spoke this week about Canada's vulnerabilities, and it should be no shock to you and I. It is all about housing. We're going to be discussing in this video how we got here, who it will be affecting the most, and what the Bank of Canada is going to do about it. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value, hit that like button for me. I definitely appreciate that. And don't forget to hit that subscribe button and turn that notification bell on, especially if you like content like this. Every single Sunday, a new video will go out. So we'll start out by talking a little bit about the mindset of Canadians dating back to many years ago, and I'll hand it over to Carolyn to discuss further.
But if you were to dig up Bank of Canada's reports on financial system stability that I just mentioned, going back as far as 2006, you would see analysis on escalating housing prices and increasing housing debt. So in other words, these two vulnerabilities have existed in Canada's financial system for some time. And the buildup of these vulnerabilities continued after the global financial crisis in 2008 and 2009. A decade of low interest rates, a growing population, and a constrained housing supply all combined to feed a steady march upward in house prices. Higher house prices meant Canadians were taking on more debt to buy their homes. And as prices continued to rise quickly, some Canadians saw housing as an investment opportunity as well as a source of shelter and took on additional debt to invest in housing. Well before the arrival of COVID-19, Canadians were worried about the cost of housing becoming detached from incomes, particularly for first-time homebuyers. And they were worried about investors contributing to the rapid increase in house prices, particularly in large urban markets. Then the pandemic hit and our housing market shifted up yet another gear.
This problem is not new to us. It's something that the Bank of Canada and many Canadians have had on their radar since 2006. From there, we head into the financial crisis, the 08-09, where we decided to print money and to put it into the hands of corporations in hopes that they would spur jobs. In turn, they also dropped the interest rates to record lows, and that made money cheap. And from there, what we see is investors over that 08-09 decade leading up to the pandemic was just investments and also a lot of real estate buying, which further escalated the problem. And then obviously when the pandemic hits, people living in urban areas that were working from home wanted to move out. And we started to see the number of transactions, the number of homes being bought and sold increase, and some prices leading up to 50% higher in urban and suburban areas, even leading into the rural areas. So that's kind of how we got here today. And the major factors is the fact that liquidity was available in the market, and liquidity was available at such a cheap rate. So taking this one step further, we're going to figure out what's going on right now in the economy and seeing who will be affected, and more importantly, who will be affected the most.
Unfortunately, this adjustment is not without some pain, and we recognize that. One group of Canadians who will be finding this adjustment painful are those who recently purchased a home, potentially stretching their budget to do so, and who chose a variable rate mortgage. This isn't a large share of households, but it is larger than it would have been based on past historical trends. This is because more Canadians opted for a variable mortgage over the last year than have in the past, at a time when housing prices were also going up. Borrowers with a variable rate mortgage will already have seen significant increases in their monthly payments if their payments are also variable. Borrowers with a variable rate mortgage and fixed payments may face higher payments if they hit what we call the trigger rate, the rate at which their monthly mortgage payment is only covering interest and not paying down the principal. Homeowners with fixed rate mortgages may also be looking at higher payments when they come to renew, depending on when they took out their mortgage and whether they have room to extend their amortization period. So the bottom line is that mortgage costs for some Canadians have already increased, and they will likely increase for most others in time. So homeownership is becoming more expensive.
And who will feel the pain the most? Well, that's anybody who's gotten into the market lately. having to buy at elevated home prices. And yes, that includes first-time home buyers. So I know Carolyn mentions the fact that it almost seems like they're recognizing the fact that this problem will continue to happen, especially with inflation being the main target, because they know that the longer term implications of inflation could hurt us even more. And what is the Bank of Canada doing about it today? Well, let's hear about what Carolyn has to say about that.
We need lower house prices to restore balance in Canada's housing market and make home ownership more affordable for more Canadians. But lower house prices will add to the stress for some people who purchased recently. They will have reduced equity and therefore potentially limited options to refinance. We know higher interest rates are difficult for Canadians, particularly young Canadians, many of whom are recent home buyers and therefore carrying higher debt loads. We don't want to make this transition more difficult than it has to be, but higher interest rates in the short term will bring inflation down in the long term. Canadians, including young Canadians, are looking for ways to protect themselves from rising prices, and we are working hard to protect them from entrenched inflation. It'll take time to get back to solid growth and low inflation, but we will get there. Working through this difficult phase, we'll get back to price stability with sustained economic growth, which benefits everyone.
And there's a lot to break down from what Carolyn has said, but in summary, the Bank of Canada knows that the housing market has run out of control, and this is not a recent problem. This is something that's been going on since 2006. The Bank of Canada and Carolyn also recognize that there will be people that are severely impacted from these interest rate increases, but they must continue with the monetary policy of lowering the amount on the balance sheet, which is printing less money, and then also increasing the interest rates in order to focus on the number one topic, which is inflation. We know that that could impact the economy large over the long run, whereas the housing market is the kind of the first area that gets impacted first. So what they're doing and what they're recognizing is there is more pain to come in the housing market. There is more pain to come for those with mortgages, and especially those with larger mortgages. But what they're trying to convey here is that the main focus is inflation, and the housing market will reap, unfortunately, the disasters of which the monetary policy which is going on today is going to impact the housing prices lower and making these houses, unfortunately, more expensive. So with that being said, obviously, you know, the fact of the matter is that we see more pain to come, and they're almost highlighting this and letting us know prior to feeling more brunt in the housing market. So let me know your thoughts down below. How much could you expect the housing market to go lower in 2023? Are we talking 5, 10, 20, 30%? Could we see a huge reduction? Let me know your thoughts down below. If you made it this far, I appreciate your support. Make sure to hit that like button. I hope you all have a great week in the markets. Happy trading.